That for me is the key to getting a business up and running, is trying to find a way where you minimize your expenditure in the early days.
Conrad, thank you so much for coming on the show.
Thank you for having me.
You're one of the Sage business experts, and you're obviously the CEO of Funding Options. Just tell our audience quickly what Funding Options is.
So Funding Options is a marketplace for business loans. What that means in practice is that small businesses or SMEs come to us when they need finance, and we have access to more than 50 different lenders. So last year, more than 50 different lenders lent to our customers. So what we aim to do is basically help SMEs to navigate this really complicated market of business lending.
Well, I know we briefly spoke off camera, right? But what are the most common reasons that a small business would come to you guys for a loan? I know you don't personally lend money, you're a marketplace, but what do they normally come for?
Yeah, so I guess fundamentally the challenge that we're overcoming is that traditionally small businesses have gone first to their bank when they're looking for a loan.
Yeah.
Over time, the appetite and the presence of banks in that market has slowly but surely declined, albeit the decline's probably overstated. So our role is to really take a very complicated market of alternative lending and make it easily accessible.
Yeah.
So in reality, we get customers coming to us for all types of reasons, all the way from a mortgage for their new office block that they're buying, all the way through to paying a tax bill on Wednesday that they forgot about. So it's the whole range of things, but I would say most of the business that we do would be working capital.
Right.
So in other words, it's those scenarios for whatever reason in the trading of your business where you have a gap in your cash flow.
Yeah.
Now, historically, businesses would have typically used a bank overdraft to get through those periods. But the availability of bank overdrafts is actually quite significantly down since the global financial crisis. So that kind of buffer that we used to rely on. Traditional loans to businesses by banks are very much back where they were before the credit crunch, but overdrafts for sort of underlying industry reasons, which I won't go into, they haven't quite come back to the same level. So that kind of buffer that you used to fall back on isn't quite there. And there's a whole host of reasons that would have driven why you used to use your overdraft. A good example is tax. So you don't pay tax on a weekly basis or a monthly basis. So what actually happens is that you get these big wedges of cash that often you're not ready for, you haven't prepared for, and they come out quarterly or every 6 months or whatever it may be. So you need a facility to flatten through those gaps. Another very common issue would be that a major client has paid you late. So you didn't create the problem, but it's your problem.
Yeah, the knock-on effect.
And you know that the invoice is going to get paid, sometimes 30 days too late.
Yeah.
You've still got to pay your staff, you've still got to buy materials, your rent. And so getting through those kind of those kind of trading ups and downs that are normal for every business.
Yeah.
Well, it is unusual the way things are today, because we obviously interview a lot of people, and when they're starting out and they say they're starting out and they need money, it's very rare that we would, because we were shocked yesterday to hear that one lady said, I went and I got a business loan, and they offered her 170,000 and she took
160 and she took 80.
She took 80. Well, I don't need that much money, I just need this much money. Super practical, makes sense, and she has 100% equity of her business, hasn't given anything away, still make all the decisions and doesn't have to run it by anybody. And it makes perfect sense. And I don't think we're seeing that enough.
I think though, probably a major reason we're not seeing that as well is because she went for a loan, but she was making money. A lot of companies now are in a position where they need money to run the company and they haven't made anything yet. And you're not going to get a loan at all if you're not making money.
Yeah.
Well, it is sometimes possible to get a loan. So one type of finance, typically called invoice finance, is a type of finance where as soon as you've got the ability to invoice clients, then you can actually raise money against those invoices because the lender knows that money is eventually going to come.
Right, okay.
So you end up paying a small margin for the fact that you're getting the money now rather than later. So there are certain types of finance that are available, or debt loans that are available really early on in a business life cycle.
Yeah.
But generally speaking, the point you make is a valid one, which is that generally speaking, lenders want a track record, and it's obvious why. It's no different to us as consumers, right?
Yeah.
If you come straight out of university, you're probably not going to get a huge mortgage. So generally speaking, your comment would be right. I'd make the observation that there's a lot of talk about equity finance investment, and I think part of the problem actually has come about from the popularity of the likes of Dragon's Den that popularizes this concept. It's really important to understand that going to external investors and getting a big check of money, to invest in your business is very rare. Yeah, I mean, you've got hundreds of thousands of businesses will get loans of some sort every year in the UK, approaching 1 million, in fact. The number of businesses that get an investment in their business in that sort of Dragon's Den way is very small indeed.
Yeah.
There is, of course, lots and lots of use of what's called friends and family, so small bits of money from within your network that get you up and running.
Yeah.
And also sometimes people, they probably shouldn't, but use personal credit cards to get up and running. But I would say the really important takeaway from that is in both circumstances, what those businesses are doing is they're getting up and running without spending much money at all.
Yeah.
And I think that's for me is the key to getting a business up and running is trying to find a way where you minimize your expenditure in the early days. So if, for example, you can continue to do a freelance job and get paid for 3 days a week, salary into your account, that's great, right?
Yeah.
So maybe start doing it at the weekends. Many of the most successful business I've known have actually done that, and only when they were established, then they could go and get a loan or investment. But it's actually really rare to go and get investment in your idea from an external investor.
When you see a lot of businesses approaching you guys or trying to get a loan, how much of that is for cash flow? Because we've interviewed so many startups since we've been doing this now for 4 years, well over, how many? Well over 2,500. And there's so many of them that don't think about cash flow. And I'm talking about the early stage companies now where they're so focused on running the business or whatever it might be, like especially product businesses where I was so busy actually making the product or whatever it might be, that they don't spend time on the necessities, which is getting the invoices out on time and then chasing the money. So a lot of the cash flow problems are people aren't going to pay the bills unless someone comes knocking on the door going, where's my money? You know, they're not going to go, do you know who I should pay? I should pay Mark and Graham there. You know, I'll pay them on time. They don't unless you go knocking on the door. So how many businesses come to you looking for money to get them out of a cash flow problem?
It's very common, and actually working capital, which the industry would call that kind of situation, is actually in volume terms is the most common form need for finance. So more than half of all needs for finance is driven by working capital or cash flow.
Is that alarming to you?
It's partially alarming, but I think it's really important to say, you know, I founded Funding Options, right? I am a founder of a business myself, and the reality is that businesses have ups and downs. And you know, we've had our ups and downs along the way. So to some extent, you know, that is the reality of running a business, and worrying about your cash flow, unfortunately, is one of those things that you do worry about. But that doesn't mean that some of it isn't preventable. And I would say one of the most important activities for a small business owner, you've already talked about one of them, which is raising your invoices, proper credit control, making sure the cash comes in. You know, a sale is not a sale until the money arrives. But the other one is cash flow forecasting. So, you know, I'm a qualified accountant, and accounting is horrendously complicated. And I don't want to think about the 3 years I spent studying it. But actually, regardless of whether you really get accounting, it really is important to actually have a forward-looking view of your cash flow. You know, when do you really think that invoice is going to get paid? Because that invoice is a big part of your revenue. You know, if it gets paid a month later than you've been thinking about, then really that will cause you trouble. So that kind of forward-looking cash flow, maybe the thing that you do on a Sunday evening when you can't speak to clients and do the stuff you love doing, that we all love doing, the bits we prefer in business. You know, maybe that's the thing you should be doing on a Sunday evening. You
remind me of actually Steve Hare there from Sage, because that's exactly what he said to us before when we were talking about cash flow. A sale is not a sale until the cash arrives.
Yeah, absolutely. You raised money, you mentioned off-camera, you raised money previously. Was that for the current business?
Yeah, so we've raised venture capital within Funding Options. I've also, you know, Funding Options itself doesn't help other businesses with raising investment, but I've been through that process myself. And you know, it's really tough. Yeah, it's one of the most depressing things about raising external investment is that you are so distracted from your business when you're in the process of going out there on the road, you know, trying to drum up interest, and the very, very technical and detailed contractual stuff that leads to the money going into your account, that you actually come back to the business. It wasn't the business, it's not the business you left. And you know, now we're a lot bigger. We've got like 80 people in the business now, or 90 people. So now I've got people who, you know, keep things running. But I remember in the early stages when we were raising the early investment for the business, you know, it felt like the business had been put back 6 months every time we raised money. And in that respect, again, you know, raising investment, external investment, equity investment is rare and it's hard, which is why, you know, only certain businesses is the right thing to do.
Yeah. When you went out to raise that money, was it in your head that I want to get smart money? So the investors that you go on board, did they help? I know you were 6 months behind, right? Yeah. Which is unfortunate because you're out of the business for so long while raising. Did they help you accelerate up, or was it a purely capital investment that you needed?
So there's obviously a benefit in bringing in investors that know your industry, but obviously not the competitors. But there's obviously a benefit in that. There's a benefit in bringing in people that have a black book that can open up. For example, if you're selling into large organizations, you know, if they've got a black book, that's great. But I would personally make the observation that the most important thing I would say is to raise money from people who've invested before. Because you know, you can be told this 100 times, and I was told this 100 times, and you still don't listen. Which is that you're going to probably burn through 3 times as much money as you thought you needed, and you're probably going to spend 3 times as long getting to where the business, where you see the business getting to. And for that reason, if you're raising money from people who've done lots of angel investing or venture capitalists, they kind of know that. They know that you're the naive guy on the other side of the table, and you say, I need £100,000, and they're thinking he's going to need £300,000.
Yeah.
So you know, I would say my particular piece of advice is try and if you're going to go to external investors, in other words, not friends and family, then try and raise from people who've done it before. Now, more recently, we have gone down that route of sort of very much the strategic alignment. So we recently actually took investment from a major bank, a major global bank, and that's because we see sort of an alignment to our ambitions. So I wanted to build a business across Europe, not just in the UK, and they have a very strong presence. So, you know, in more recent years, we've begun to really look for that strategic alignment because, you know, you're getting into bed with an investor for a long time, and a lot will change in the period that they're in the business. So if there isn't that kind of strategic alignment in terms of, you know, you kind of see where you want to get to and how it's going to get you there together.
Yeah.
Then, you know, when times are tough in the business, then things will get very frayed.
Well, Conrad, look, there's so much advice there for the entrepreneurs that are watching. We really appreciate your time, and thank you so much for coming in.
No problem.
Thank you.
It's been a
Thanks,
pleasure.
Conrad.
Thank you.